Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, hello and welcome to another edition of your favourite investment and business show, the ASB Investment Podcast. I'm Nigel Grant and today we're focusing on one of the most critical annual updates for funds that ASB investors use. We call it the Strategic Asset Allocation Change or kind of process, or SAA, which we'll use throughout the show. And we'll take you through what the ASB and BlackRock teams have made, any decisions and reflections they've made for during this year and to set us up into the next kind of 12 months. This is just as applicable if you're not with ASB for your investments as well. So most providers have a sort of process they go through regularly where they review what they're invested in. So this chat will help you understand that concept broadly too. So joining me today are Frank Jasper, both returning champions to the show. Frank Jasper, ASB Chief Investment Officer, and Will Porter from BlackRock. Gentlemen, thanks for being here, and how are you?
Kia ora, Nigel. Very good, thank you. Very good.
Yeah, thanks for having me, Nigel. Nice to be here.
We've just we were saying before we started recording, we've just spent basically 2 days together doing trips around Hamilton and Tauranga for the last couple of days, meeting with clients and ASB team members and hosting events. Frank, any reflections, I guess, well, if you want to add anything as well, but Frank, any reflections from your trip after spending so much time with me? No, I mean with clients and staff members?
Well, look, clearly, Nigel, the highlight of the trip was the time I get to spend with you.
Thank you.
Poor Nigel, I feel very sorry for him. Look, it's always really good getting out and listening to the issues that Kiwis have got, how they're thinking about money, how they're thinking about building their own investment program. I guess the main theme that came through today in the last couple of days, and this is probably hardly surprising given the news flow we've got, is just this uncertainty about the environment that we're in. We've got tariffs, we've got these roaring share prices in AI stocks, we've got the Kiwi dollar moving around. So people are really interested in, hey, how do you manage money in this really dynamic environment, and how do you make robust decisions for the future with so much apparently changing on the surface?
So Frank, diving straight into it, can you share a little bit about what the Strategic Asset Allocation Process is, or SAA? Like, what is our regular review? Why do we do it, and why does it matter so much to investors?
Yeah, so this is a absolutely critical part of the investment process we've got at ASB. And I like to think about how we manage money in sort of two big core steps. The first of those is to have this long-term strategy that essentially you could live with regardless of what happens in the world. That sets the amount of risk you have in your portfolio. It kind of drives the amount of return you're likely to get. But of course, we know the world is this really dynamic place. Things change, economies rise, they fall, currencies move around, valuations of markets change. So we can reflect that in the actual things we do day to day. So it's almost like an overlay on top of that long-term process, both defending and protecting the portfolio from the risks that we see in the world, but also embracing the opportunities that the world presents from time to time. So it's the way that we reflect the dynamism of the world and really try to add a bit of extra return to client portfolios. It is really important. We've been adding on with our wonderful friends at BlackRock, been adding sort of 0.5% to 1% to returns pretty consistently over time through this process. So really important part of the value add from ASB.
Because there's two parts, right? There's sort of a reference portfolio that you set, which is sort of the as simple as basically how you measure what you do in the funds, and then you've got what you actually do is your strategic moves. Is that a fair enough kind of description?
Yeah, but also that reference portfolio really dials in the level of risk that you want. So we know
so it sets the bar.
Yeah, we know every customer has got a different risk profile. So some people are very conservative, some want more growth in their portfolio. That reference portfolio dials in that level of average risk, and then what the ASB and BlackRock team are working together on is that smart value add on top of that to reflect what's going on in the world right now.
So that last bit's probably the key thing, that what you pay someone to manage, right? And do for you, as opposed to DIY.
100%.
Yeah. And so, Will, lots of clients were keen to hear from you and BlackRock on our travels, but, what would you say are some of the most notable changes in ASB's portfolios, whether that's things we've done to date or kind of what we've just done?
Yeah, so there's a few things there. Maybe if we talk about what we're looking for in the go-forward strategic asset allocation. So if we think about it from sort of the big picture drivers of portfolio construction and what will drive outcomes, the most important one's kind of how much growth in defensive assets you have in a portfolio. And in this year's SAA review, we are maybe a little bit under on our growth defensive split to what would be a neutral stance.
So a little bit less growth? Is
A little bit less growth, not a meaningful amount, but it is just a little bit lower than what would be neutral.
Yep.
And that really reflects a lot of the uncertainty that's occurring in markets at the moment, and also sort of the more positive return expectations from fixed income assets than what we've had previously as well. So that's kind of the big picture view.
Yep.
And then when we dig into sort of each of the underlying growth side of the portfolio and the defensive side of the portfolio, on the growth side, we've done a little bit more diversification. So that's been a bit of a theme around the SAA over the past few years, is diversifying those levers of growth in the growth side of each of the investment portfolios. So what we've done there is add a little bit more to emerging market equities out of global equities. And we've also included some high yield bonds in the portfolio as well. Now, they sit as what we would call a bit of a hybrid asset. They have some features of growth assets and they have some features of defensive assets, but we think they're a very attractive asset class at the moment. Their sort of expected returns broadly equivalent to what we think we'll get out of global equities, but the volatility that they introduce is about half of what you get from global equities. So they look like they have a worthy place in the portfolios at the moment.
And a high yield bond simply just bonds that have a higher percentage payout? Or is it sort of a bit more to that?
Yeah, they tend to have a higher yield attached to them, as the name suggests.
We're very good with just conventional namings in finance, aren't we?
Exactly right. And they are coming from maybe some issuers that are kind of lower on the investment grade spectrum than you might otherwise expect.
But still need financing.
Absolutely, absolutely. And these are kind of broadly syndicated, listed investments as well. So, yeah, they have a compelling place in the portfolio when you think about kind of the risk-adjusted return. And that's really the key decision that we make around any of the assets that we consider for the portfolio, is how do they stack up on a risk-adjusted basis. And then when we think about the income side of the portfolio, a feature of the ASB portfolios has been the addition of inflation-linked bonds, and we have continued with that stance as well.
So inflation's sticking around?
Yeah, we think so. Well, we just don't think it's as well priced in inflation-linked bonds. So we think there's a good potential that inflation will print a little bit higher than what markets are expecting, and that's what inflation-linked bonds will capture. So we either win in the short term, where inflation expectations reprice and the value of those inflation-linked bonds goes up, or through time, inflation prints above what markets expect, and we earn on the inflation-linked bond side. And then the other piece is we've had lower duration, and so this is shorter-term government bonds in the portfolio.
So not like 30-year or 50-year
that's
things.
Right. We've had this sort of 1 to 10-year exposure, and we've continued with that stance as well. We think we're still getting reasonably well paid for shorter duration government bonds and don't need to reach out the duration curve to pick up a higher yield, for example. So that's another feature. And, of course, gold, which has been a position in the portfolio.
A lot of questions on gold we're receiving.
Yeah.
And so, Frank, we had a few questions on the road around, currency and what are our thoughts on that and that US dollar type thing. Do you have any to add to what Will's been saying? Has our position on currency changed or anything, or are we still kind of where we've been for the last few years?
Yeah, so currencies is a super fascinating thing to me. So we do have more exposure to foreign currencies in our portfolios than many other KiwiSaver or investment providers in the marketplace. And you might kind of wonder, why is that? And there's a couple of really key things that drive that decision. First and foremost, there's been this tremendously interesting relationship between the value of the Kiwi dollar and the direction and momentum and strength of global share markets. And what we see there, the phrase that we use in the marketplace is they've been negatively correlated typically. So
they move in opposite directions.
They move in opposite directions. And that has a really nice effect on your portfolio, that it reduces risk without reducing return. So we're always looking for levers we can pull to either push return up without costing a lot of risk, or drop risk without costing return. So that correlation benefit is really powerful when we build a portfolio. But I think there's a much bigger story that is not as well understood by most Kiwis, and that is that we've got this massive personal exposure to the Kiwi dollar. If we're lucky enough to own a home, that's obviously a Kiwi dollar asset. For most of us, not when you're my age, but when you're a young man like Will or you, Nigel, the most valuable thing you actually have is the net present value of your future earnings. So all of that pay you're going to receive over the rest of your life, that's a very valuable asset. But again, that's a Kiwi dollar asset if you're based here. So we've got this massive exposure to the Kiwi dollar. That's great if the Kiwi dollar is strong, but if it's weak, that's actually a real risk to us. So having some offshore currency, some euros, some yen, some pounds, some US dollars really protects your global purchasing power, and I think is a not well understood risk management dynamic that all of us should take into account.
And it's the same principle, I guess, not just having exposure to other currencies, but having exposure to other offshore assets, right? Because that point's landed really well about the job, your house, all being domestically focused. It's about getting access to a lot of things offshore, right?
Absolutely. So the currency is one of the things that comes along with owning those offshore assets. So, of course, I want to own shares in Apple. I want to own shares in Nvidia. I want to own shares in some of the best companies in the world. Turns out they don't all happen to live in New Zealand. So that's very attractive. But at the same time, you can then get exposure to these offshore currencies, and that has this tremendous lifetime wealth diversification benefit that, as I say, I don't think is as well understood as it could be.
Yeah, a lot of eggs in, different baskets potentially. So, Frank, why have we made these particular shifts in the latest SAA process? Are there any risks or key risks or opportunities that we're aiming to capture or conversely avoid?
Yeah, so I always think that's the right way to frame it is, hey, can we reduce risk and are there opportunities to embrace? And I'm going to let Will chat on this topic because he's much more eloquent on it than I am. But there's a connective tissue that I think really describes the thinking that underpins the SAA framework that we're using. And for now, we talk about that as this idea of these mega forces. And these are these long-term secular trends. Now, again, what do I mean by secular? Some things work in cycles that there's
cyclical, right?
The economic cycle is a perfect example of that. Secular trends are things that are enduring through cycles that we don't think, hey, this is a 1 year, 2 year, or 3 year thing. These are 5 to 10 year mega trends, mega forces that will drive the allocation of capital and markets. So we're really cognizant of those when we build our SAA and how we look to both manage risk and embrace opportunity. But I'll leave Will, the real expert, to chat on those. But again, I think it's just a background thought process. Yes, we should think about cycles, but we do need to think longer term when we build portfolios. And again, I think for everyone listening, just a good thing to bear in the back of your mind.
And before you get cooking on that, we've talked before, obviously, about megaforces, but you guys see them as the new anchors, right?
Absolutely, yeah. Well, there's two pieces of that. One is that maybe some of these longer term macroeconomic anchors that we used to rely upon for sort of portfolio construction and capital market forecasts maybe aren't as prevalent as they were historically. Mm-hmm. So this new framework of thinking about things in this megaforce framework seems to make a little bit more sense, and it has been the backbone of how we've built portfolios for the last 2 or 3 years, and it continues to be the backbone of how we build these portfolios, and it's captured in those forecasted returns that kind of underpin how we construct the portfolios. So maybe we should talk a little bit about what those mega forces are. And I think I've covered this a few times on the podcast here, but really there's 5 mega forces that we think are kind of long-term trends that are going to drive kind of outcomes over time, and they are demographic changes. So this demographic divergence is how we refer to it. And that is that we have these kind of differences in demographics around the world. So developed markets perhaps maybe a little bit more aging in their populations, and that poses some challenges. And then we have emerging markets, for example.
Why are you laughing?
Sorry about that, because I just feel a little bit offended when we talk about aging populations as well, but that's all right. I'm feeling a little singled out in the room, but that's okay.
Some countries are going the Frank direction, others are going the Will direction. So back on track now after you were rudely interrupted.
Yes, sorry, apologies, Frank. Yes, so we do have emerging market economies, many emerging market economies, for example, have younger, more youthful populations, and that drives potentially better long-term economic growth outcomes. So that is one of the kind of reasons that emerging markets look like a really attractive investment for us, and that's why there is some risk that we've allocated to that across the portfolios. The other is this deglobalization, and this is a really, I suppose we're getting a lot of evidence of this at the moment with some of the volatility that we're seeing around the world.
Every day.
And we do get some sort of, the tariffs that we've seen and the like. There's obviously evidence that the world is a little less globalized than it was previously. And again, this kind of has some inflationary impacts over time, right? We're a little bit more supply constrained. Supply chains have shifted a little bit. And that was sort of really came out in the COVID period, where we saw companies and consumers kind of diversify their supply chain. So they went from being the most efficient to maybe
cheapest,
being, that's right, to maybe being, how do we secure our supply chain? And that has some inflationary pressures that will play out over time. It's going to take a long time for these kind of supply chain issues to kind of reinvent themselves. And that's, again, again, kind of one of the reasons that we have both gold for their kind of volatility that deglobalization introduces, but also sort of supports that inflation-linked bond allocation that we've got as well. Then we have digitalization is the other mega force that we talk to. And this is, the rise of AI and the ongoing transformation of things to a more digital world. And it kind of ties in quite nicely with another of the mega forces, which is about kind of decarbonisation and energy transition. And obviously the rise of AI is quite power hungry. There's going to need to be a significant amount of investment to kind of facilitate the adoption of AI. And that also occurs at the same time that kind of globally we're trying to decarbonise and look at more carbon friendly energy sources, for example. Again, both of those are kind of, number one, very attractive from an infrastructure stance. There's obviously a lot of investment that's required to facilitate the adoption of AI, and predominantly that comes through in infrastructure as well. The final one is future of finance.
You remembered all five.
Yes, that's it. Yep. Future of finance is the final one, and this is really about kind of how banking and things is working around the world. And there is a little bit of a change. We've seen kind of the rise of private debt and all of these things, and India is a great example where we've seen broader adoption of kind of digital banking, and that being kind of a core piece. We think that creates some efficiency, and again kind of supports why we might own some emerging markets as well, with India being a pretty significant component of the emerging market benchmark, for example.
Yeah, and I think, Frank, before I go to you, I think the more and more I hear about kind of the mega forces, they're almost like, I find them a bit of like a reassuring, to your point, like things are going to be happening for 10, even maybe 20 years. They're things you can, like, quite a ballast you can just sort of anchor things on and maybe invest for the long term. I mean, Frank, before we go to the next section, do you have any final thoughts maybe on the mega forces, and kind of, is there a standout one for you, do you think?
Yeah, I might just pick up on your theme there though, Nigel. And I think the thing that's really interesting for me with that is that market cycles will still operate around those mega forces. So that's when we think about how do we articulate these things in portfolios, things like the AI journey and the digital disruption is clearly a major market driver right now. There will be pockets of that market that look pretty pricey right now.
Yes.
And the word bubble gets thrown around a lot. You know my view on that word, Nigel. I'm always very cautious of using absolutes
Little
when we
b
describe
versus
things.
big B.
Yeah, absolutely, because it hides a lot of detail and nuance that's really important. So the mega forces from time to time will provide massive opportunities for us to make money. From time to time, they may present risks that we need to protect the portfolio against. And so if I think about our positioning on AI and digital disruption right now, we've swung a little bit away from the obvious primary beneficiaries by being slightly underweight global shares towards the more secondary beneficiaries in the infrastructure zone. So they're not necessarily guaranteed money-making ideas. What they are is a wind that's blowing through the global economy, and we can choose how we set our sails to that wind to take advantage of it from time to time. So
your SAA process can oscillate around a secular trend. Would that be fair?
Absolutely.
Right.
And find out where the pockets of opportunity and risk are within that broader trend. And as I say, for AI is, I think, the most interesting case study in that right now, that the primary beneficiaries we're actually slightly underexposed to, but the secondary beneficiaries, the power systems, the infrastructure, the data center providers, they're areas of more focus for us right now. And we know eventually the real benefits of AI will accrue to operating businesses, to software companies, to new businesses that none of us have even heard of yet. And that'll be another opportunity that comes from this broad trend. But how you play it from a financial market point of view can be quite subtle and targeted over time.
Yeah, and can change and adapt, yeah.
Yep.
You mentioned infrastructure, and infrastructure we think is really kind of sits at the heart of the mega forces. It is impacted by all of those 5 mega forces that I mentioned, and that's why it has quite a worthy position in our portfolio. It is, deglobalization, rewiring of supply chains requires infrastructure investment. Demographic shifts requires infrastructure investment. Maybe it's different in emerging markets to developed markets. You touched on digitalization, you touched on decarbonisation there. All of these require infrastructure investment, which is why it's an attractive asset class in this year's SAU, and it was an attractive asset class in last year's SAA as well.
And I'll add one other thing to that makes real beauty to this asset class is often quite inflation protected as well. Yeah. So if you think about that geopolitical fragmentation, that concern we have about inflation being persistent, a lot of infrastructure investments have got inflation adjusted cash flow characteristics to hedge inflation risk. They're a wonderful asset class.
And so but what does that mean? Is that basically they can put their prices up to keep pace or outpace inflation?
I think everyone who pays their contact energy bill or their mercury bill is pretty aware of this one, but they very much keep pace with inflation. So
because you need power, you need water. I guess you got to use roads.
Yep. And these firms have got a lot of pricing power that often, in some cases, contract with CPI plus cash flows, and in other cases, a little less tightly associated with CPI, but still pretty much track around that. So it's really interesting kind of cash flow dynamics that really fit a portfolio very well, particularly if you think inflation's going to be a persistent risk.
And just one final point on that, just to round out in case it wasn't clear. So we have those in the portfolio, because we didn't really mention that at the top, that they've already been in the portfolio and not a change as part of this SAA.
Yeah, absolutely. So infrastructure was introduced last year,
Yep.
And it's there again this year. And it would probably be a challenge for it to not be in the portfolios. But again, we're very much aware of kind of market pricing and what gets priced into these assets. So if it comes to a point where all of these great factors that we talk to is well and truly priced, maybe it might be time to think about other things.
Just like a good infrastructure asset, very hard to shift.
Yes,
Yeah.
That's right.
So, Will, how is BlackRock approaching the outlook for the next 5 years as such? We talk about this process we do annually for SAA, but are there any scenarios you're considering as part of this year's CMAs or capital market assumptions?
Yeah, so the BlackRock Investment Institute kind of sets up our capital market assumptions, which are our forecasts over multiple tenors, but in this circumstance, we'll talk to the 5-year expected forecasts across assets. And there's been a little bit of a shift here in that we're now considering multiple scenarios under that capital market assumption framework. And we think that's appropriate at the moment, where we don't think a sort of central forecast captures all the potential outcomes that are available at the moment.
So multiple futures.
Yeah, potentially.
Okay.
And within those multiple futures, quite different outcomes for different asset classes. And that's why we consider these multiple potential outcomes. So within that, we have a central scenario, which is sort of all of the information that we know and is available to us at the moment, and how we think that will play out. And that's sort of forms the core of our strategic asset allocation approach. But then we have these two other scenarios. One is maybe a little bit more risky, I suppose, one way to put it. And that really reflects kind of expanding risk premiums. So people demand a little bit more return for their investment. And maybe that comes from heightened globalization or geopolitical tensions and the like, which kind of puts upward pressure on bond yields and the like. And the other is a more positive scenario. And that really comes down to kind of a broader adoption of AI. And we call this kind of an AI-based theme. And that kind of shows like far broader adoption of AI and quicker improvements in productivity off the back of the adoption of that AI. So we sort of have this core base case scenario around our capital market assumptions, and then we stress that with these two tail scenarios to ensure that the portfolio is pretty well positioned in any of those outcomes.
And do those kind of three, I guess not to contradict necessarily what the BII is saying, but Frank, do those kind of three theses, I guess, align with where you could see things going?
Yeah, look, I think they are good scenarios. The broader point I would make from thinking about this, though, is that it's very tempting when you listen to people in suits talking about their view of the world to overanalyze or overthink that they're going to be right on something. We actually take quite a different approach in that we're saying, hey, we know there's a lot of uncertainty in the world. Our job's actually to manage with that uncertainty baked into the cake. So don't fall in love with your predictions. Fall in love with the fact that there's actually a variety of possible different outcomes, and build a process that's ideally robust for those different scenarios that could play out. And I think, again, if I'm passing on thoughts to people as investors, learning to live with that uncertainty and learning to think, hey, I'm not going to optimize my portfolio for one outcome. I'm going to create robustness across a range of different possible outcomes so that I'm okay whatever happens. I think it's a really important thought process for all of us to take into account, and it's something that's explicitly thought about when we build our SAAs. But for a lot of people potentially listening in, I think it's just a really good thing to think about yourself. And what does that mean in practice? It means more diversification. It means having different assets in your portfolio that perform well in different environments. So an inflationary environment, your infrastructure shares, your inflation index bonds do really well. In a more deflationary environment, your nominal bonds do really well. So it's making sure that you're to use Talib's phrase, you're anti-fragile. You are building robustness and anti-fragility into the way you think and build portfolios.
But it's, I guess the key takeaway for me there is it's okay to say you don't know what's going to happen? Is that
I think it's critical to say you don't know.
Yeah, and avoid someone who says, I know for sure.
That is called hubris, and it is a very quick way to lose a lot of money.
So finally, Frank, what are some of the key takeaways for listeners about how we manage money, or, I guess what our ambitions are as a wealth provider? We've been doing this question and kind of, this conversation with customers over the last couple of days. What are the key things that are on your mind? Are they the same things before those events that are populating your ambition as such?
I'm very ambitious for what ASB can do for Kiwis and helping Kiwis grow their wealth. We've been working with BlackRock. I've got to say, very fortunate to have really great investment results, something we're very proud of. But the thing that I'm focused on, the thing that Will's focused on, is how do we keep building a robust, thoughtful process that drives those outcomes. So this is a process-driven business. And I think clear. For all of us and all of the people listening on this podcast, how do you keep iterating, building your process, learning from the things you get right, learning from the things you get wrong, and build a better and more robust process. If you focus on that, I think you build a kind of intellectual and muscle memory capability over your investing life. If you focus on the results, they can oftentimes send you in the wrong direction. So our ambition is to keep really iterating and building on this process, finding smarter ways to add value to customer portfolios over time. If we do that really well, we'll generate great returns. We're doing that to date, but we can always get better, and it's a lifelong journey for us.
And I think what comes through clearly is that outcomes, focusing on the outcomes can sometimes prevent you from continually stress testing and thinking about your process. I think what comes through really clearly is almost like the way you guys work together to almost just keep testing each other and your teams. Are we right? Are we sure? But then plan for the things we don't know.
Absolutely. And it's sometimes a well-worn analogy in this marketplace, but you don't drive down the road staring through the rearview mirror, right? You look out the front and you try and figure out what's coming.
Yeah,
absolutely.
Okay, so to wrap up, thank you both obviously for the insights and putting up with me for another few hours after we spent the last few days together. I hope it doesn't come through that we're tired. We're still fizzing to hang out with each other and just keep that going. What we've tried to do here is give you an insight into our SAA, or strategic asset allocation process, how we think about the world and what goes into the decisions about where we invest, your money as such, and clients. We're seeing, as Frank said, some really, really strong results, and that's indicative of the 4 years of working together, hand in glove with BlackRock. To our regular wrap-up question for you both, what's something, we'll start with you, or start with anyone who wants to go first. What's something you've been reading, listening to, or watching that you can recommend to our listeners?
I'm happy to jump in first. Yeah.
Okay. I just thought I'd leave it hanging. Wanted to step in.
Absolutely. So I've got a book that I've been reading recently. It's called Atomic Habits.
Oh, great. I've heard of it.
Yeah, fantastic. And it's really about kind of building very positive habits and maybe how you can approach breaking some more negative habits. But it's been a fascinating read, and I'm really enjoying that. So I would definitely recommend.
As you said that, I just find it hard to believe that you have any bad habits.
No, of course not. I'm perfect.
That's right,
Nigel.
That's what I've always thought. Yeah, that's.
He actually sends out this really good weekly email that I would recommend everyone sign up to.
Do you know who he is?
It's James Clear.
I think it is. Or Cleary?
Cleary, okay. Yeah, I forget the exact name, but it's Google Atomic Habits email, and it's 3 ideas from him, 2 thoughts from somebody else, and 1 quote. It comes out on, I think, a Friday. It's super pithy. It's like a 30-second read, but I will say every single time there's something in there that just clicks a little thing in your brain. It's well worth reading. For me, Richard Thaler's he's a really important behavioural finance economist. He's got an update to a book that came out a little while ago that's on pre-order at the moment, so I have not yet.
He wasn't the Nudge author, was he?
So I've just hit go on that book. But understanding ourselves as humans, understanding the things that are wired into our brains, they are so important to becoming a good investor. They're unavoidable. We've all got them, but understanding is the first step to designing processes and techniques for managing them. An area that's been fascinating for me for a long time. I think it can really help you be a better investor. So behavioural finance, anything you read around that, you'll learn a lot, and I think really up your game on investing.
My one was, obviously it's come through clearly that we've been out on the road with clients, but my thing was in terms of the listening to is, the highlights have been spending a couple of days with, not just you two, but clients has been fantastic, because you can't you can get stuck at head office, and getting out and spending time with them, what they're actually asking you, what they want to know about, is fantastic. We've got, in a couple of weeks, we'll be back in the ASB van. I picture it like, with some sort of travelling band or something. Yeah, but visiting Christchurch, Wellington and Hawke's Bay. So client events there. We're also, so if you're keen to get along in those areas, reach out to your ASB wealth manager and see if you can get along. But we'll also do a wrap-up podcast as well in terms of the key things, life on the road. What are the questions that have come up and how we answer them? I'm not sure who we're going to have on the panel there, but we'll see if we can get you both back. Who knows? That's it for today. I just want to thank you both for spending more time with me, and you're both flying out after this.
Absolutely, yeah.
Okay, one's going domestic, one's going international. So, you're going different terminals as such. Thank you both so much. We'll see you again soon. And thank you for listening as well, as always. Take care out there. Happy investing, and bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.